This is Scott Becker with the Becker Private Equity and Business Podcast. Thrilled today to visit with Sean Frank. Sean's the founder of the Cloud Equity Group, which he founded more than 10 years ago now, investing and hosting and so forth. Sean, tell us what you do and tell us about yourself. Then we'll ask you where you're most focused about this year, what you're watching in the investment environment, and a lot more. Thank you for joining us. Sean?
Sure, Scott. Thanks for having me. So Cloud Equity Group is a specialized asset management firm. We're based out in New York. As you mentioned, we've been in business now for 10 years. Our core business is traditional private equity. We focus on tech-enabled business service providers. So you can really think about any kind of B2B service provider that supports, promotes, powers, or enables cloud or remote connectivity. We do buyouts there in the lower end of the lower middle market. We typically like to be the first institutional capital into what are, by definition, small businesses, and really the conduit that'll transition these small businesses to institutionalize and investable companies. We execute on buy and build strategies there. And so we'll look for a lot of similar type businesses that will roll up into larger platform, often focusing on geographically focused service providers and turning them into, nationally recognized business service provider. About 3 years ago, we started a direct lending business as well, still focusing on primarily same sectors and, really trying to look at ourselves as being a strategic capital provider, still to those businesses, even without the majority control. So I've been building that book of business nicely. We're in the market, or we're in the process right now of getting our SBIC license. And, hopefully next year we'll be launching what will be our first SBIC private credit fund.
Congratulations. And tell us how you ended up in this area and sort of how you sort of define lower middle market. What size companies are you investing in?
Sure, I'll go in order there. So I have a very non-traditional path into private equity. I actually started as a very young strategic operator. I started my first business, which was a web hosting company, when I was 12 years old. It caught the tail end of the dot-com boom, and it grew relatively big, relatively quickly. By the time I was in high school, it was an international conglomerate with service teams and service being provided literally all over the world. Up until that high school point, I had really learned everything on the fly. You don't really get a formal business education in middle school, or really even high school for that matter. And it was while in high school that I connected with a mentor, a guy named Andrew McKelvey. He was the CEO and founder or the original CEO and founder of Monster.com, the one who'd taken it public, and at the time was running a private equity shop in New York called Blackfin Capital. I think they had about $1.5 billion under management at the time. And so he really became a mentor for me, and really taught me how I can grow and scale my business further inorganically through M&A and buying out my competitors or similar businesses. So while in high school and, throughout college, did, a couple dozen acquisitions, starting small and, slowly working my way up and really growing the business. Learned a lot over that period of time, not just in how to really formalize my business and run it a little bit better, but I think most importantly that I really loved M&A, and, I didn't see myself as kind of a long-term CEO of a company, but, much more liked the idea of, just doing transactions and buying and building and selling. So after college, decided to, get my CFA designation, had an undergrad in finance at the University of Pittsburgh, and then started Cloud Equity Group shortly thereafter. We started, initially as an independent sponsor, doing transactions in, really the same sector that I had been working in for a decade previously, doing, hosting company, completely unlevered transactions and just buying what we thought were undervalued businesses, fixing whatever problems that we saw, operational inefficiencies, and, ultimately looking to sell. And, over the next 9 years, bringing us, forward to today, slowly transitioned both in terms of investor sophistication, dealing, with initially, predominantly high net worth, friends and family, to today, investing on behalf of our institutional investor clients. And then also in terms of structure, transitioning from the independent sponsor model to today, where we invest out of discretionary and committed investment funds. In terms of acquisition size that we like, I mentioned before that we typically like to be the first institutional investor into a business. And so we're looking at companies really going up to probably about $1.5 million to $2 million in EBITDA. We look at that as a relatively untapped market where it's too small for a lot of the other institutional investors, other private equity or independent sponsors that, like the spaces that we operate in to really want to, get their hands dirty and get involved. And so, we're buying, as I mentioned before, often from the original founders and really looking at ourselves as the conduit that'll take those businesses that, are, really not institutionalized, small business in nature, still being run day to day by the original founders and transitioning those companies into ones that, can take on institutional investment.
So just take a moment on, you said originally acquisitions that were non-leveraged. Where are you at today in thinking about leverage? How do you look at leverage today?
Yeah, so we started off completely unlevered, and there's a lot of different reasons for that. Obviously, as the new emerging manager, access to debt capital markets is a little bit difficult. I think also one of the things that historically has been a very limiting factor is because we're looking at smaller deals. Our first transactions might have been 200, 300, 400K in EBITDA, and traditionally there's not a lot of lenders that are willing to put debt into companies like that. And so, we really had to focus on, finding what we really believe to be undervalued businesses and really kind of put our brain to work and see, can we really add value to the business? And, I think as we fast forward today, that was a really meaningful step for us, because as you look at, most firms that do leverage buyouts, which is what, pretty much all of our transactions on the equity side are today, obviously you're looking for, or all the managers are putting debt on the balance sheet and they're paying off the debt, and that's some attribute of the overall return. But the uncertainty really differentiates the good managers from the great managers, are the ones that can actually add value to the business as well and get that multiple expansion and hopefully some organic growth on top of that. And I think that from our earlier days of doing purely unlevered transactions, we've really been able to show that our investment thesis and our ability to drive returns doesn't just come from putting debt on a balance sheet and paying it down, but we can actually, point to a successful track record of identifying, what we believe to be undervalued businesses, and point to the value creation that we're able to, put on the businesses.
Thank you. And take a moment on this concept of sort of a CEO who's a platform CEO, but has not yet done acquisitions. Any thoughts on, is there a learning curve on doing acquisitions? Should someone start in that position with small acquisitions, even though people say they're just as hard as big acquisitions, to sort of get their hands around what acquisitions look and feel like? Or do you not look at it that way? How do you sort of look at a CEO that's been in an organic growth business starting to look at acquisitions in the right way to sort of grow into that role of being an acquirer versus just an organic builder?
Yeah, that's a really good question. I mean, I think there's a lot of different routes you can go. Certainly if you're the CEO of a business and you're going to make an acquisition and there's no third parties that are involved, on the buy side of that acquisition. So in other words, you're funding it either with, recycled cash flow, or you're putting money into the acquisition, or, your business is taking out a loan. No other parties involved on your buy side. Certainly starting small is, a no-brainer. There's a lot of things that go into acquisitions that, are very different from just running a company that you're familiar with. There's a saying, you don't know what you don't know. And, it can be very true in acquisitions if you're not used to due diligence and understanding other businesses and how, their operations or, their logistics may be different from yours. But I think if you're a CEO and, are looking to do an acquisition and, obviously depending on the size and your company or whatever, there certainly are a lot of capital markets that are available to, help with, these add-on acquisitions. And they don't necessarily need to become investors or equity holders in your business, but they can have some kind of stake, whether that's through a minority equity investment or, a debt from a strategic capital provider or, what have you, where they can look at the acquisition with you and kind of guide you through it. And, they have some skin in the game, at least for that acquisition. And I think that's a really good route that a lot of CEOs can go, whereby they may have an expertise in a certain sector and in running a certain type of business, but don't necessarily have the expertise with M&A, and then aligning themselves with a strategic capital provider or investor, whatever that has, a little bit more of that M&A experience can kind of walk them through the process from, preliminary evaluation, what's important in the deal, what's not, to the letter of intent, to, understanding where the risk centers are and how can we mitigate that through a purchase agreement versus, what do we really have to have a good understanding of, within the due diligence. I think it can add a lot of value and make it a lot easier and less stressful for a CEO who's doing, maybe a first or second time acquisition to scale their business.
Thank you very, very much. And another question, and this might be before your time, and you don't have to answer this as too hard a question, Sean. Okay? You with
Sure.
me? The question is Tony Dorsett the greatest running back of all time or just the greatest running back out of the University of Pittsburgh?
He's definitely up there. No, he's definitely up there. In terms of football, he's definitely, I'd say, at least top three. I can't come to mind on who, maybe the number one would be, but I would definitely put him as the top three out of Pitt.
No, phenomenal. I mean, probably the best out of Pitt, but probably not the best running back of all time. But a great. I mean, are you ever amazed at what you've built, sort of starting in junior high to what you've built today in terms of a private equity fund and what you've built? Do you ever look back at it with your colleagues, your partners, your founding partner, and think, how do we get from there to here, from a junior high entrepreneur, and I'm going to ask you about that in a second, to the private equity fund we have today? Do you ever look back in amazement at what you've built?
Yeah, absolutely. And I think probably the most amazing thing to me is that, much of it wasn't planned. It was just, opportunities that presented themselves, being at one stage and seeing how do we get to the next stage and how do we continue to grow and expand. 10 years ago, I didn't think today that we would be investing out of committed, discretionary private equity funds, perhaps still in an independent sponsor type model or maybe in single investor fund type model, but, obviously have moved significantly there. 5 years ago, I would have said, we're going to be issuing, direct lending or, loans or minority equity investments into other businesses that we don't have control on. And that's been a progression for us as well. So it's been very enlightening and inspiring just to look back at our own, kind of track record and how far we've come without, necessarily having the foresight that, we would be where we are today. And, I think that's what we're very optimistic about as we look to the future and just, how are we going to look, 5-10 years down the road as we continue to grow and expand and move into different areas and, hopefully continue to find success there.
And so another question, many people that start as independent sponsors, they view the holy grail as getting to the spot of having committed capital, not being an independent sponsor where they have to find money for each deal and so forth and so on. Now that you're in the committed capital world, that you've moved into actually having committed capital, LPs and so forth, do you ever think back and look at it and say, oh my goodness, in 10 years, I want to make money being in this business, then I want to go back to being an independent sponsor? Do you ever, because some people get to that spot where they love being an independent sponsor, there's a lot of freedom, but you can't grow as big. They get to the PE side, now they're on the PA side, and they think, my God, it might have been better to be an independent sponsor. Do you ever have any sort of like questions about the path or just sheer excitement that you've been able to graduate? And I say graduate, which is really the wrong word, but evolve from independent sponsor to PE committed capital. Any thoughts along those lines?
Yeah, that's a very good question. I know it's a common theme that you'll get if you go to any independent sponsor conference or any, kind of organization that has independent sponsors is what's the better model, being an independent sponsor or investing with discretionary capital. And there are pros and cons to each, but I think to your point, the pros of investing out of discretionary funds, far outweigh the cons. Obviously when you have to raise capital on a deal by deal basis, it can be very labor intensive. It doesn't really add a lot of certainty, in your deals to close. And I think probably now more so than ever, as, all these groups are competing on limited deals where, they can actually get across the finish line today, given, current macroeconomic environment, certainty to close is a very big factor. And I've seen a lot of independent sponsors really go under or, just kind of stop making new deals in the past, year, 2 years, really because of that specifically. And so I think having a discretionary fund and having that certainty to close when you're, talking to sellers and looking to make an investment really adds a lot of credibility. And it also helps to make better value investments, right? Because, if we're competing on a deal against an independent sponsor and, we don't necessarily need to have the highest valuation. And often in our deals, we don't have the highest valuation, coming into the deals. But one of the things that we can really differentiate ourselves with is, our certainty to close. And because we do have discretionary funds and, on the debt side, we're investing with committed acquisition term, facilities. From a signed letter of intent, obviously subject to due diligence, you can, be relatively certain that we'll be able to close in a relatively short period of time. So I do think that now more than ever, kind of discretionary funds have an advantage over the independent sponsors. I think as we look ahead, for me personally, I don't see us going back to the independent sponsor model. And it's nothing negative against that. As I said, there are pros to the independent sponsor model, but I think that from an operational perspective and really from our ability to source opportunities and kind of convey to the sellers that we can move very quickly and we're effectively a cash in hand buyer, I think it adds a lot of weight, and that really translates to our investors and a competitive advantage that we can offer to them in getting better value investments. And so I do see continuing to invest out of committee funds being our future, and that probably to grow and expand. But I don't see as a firm us transitioning back to having to raise on a deal by deal basis.
Sean, thank you. Just literally a great perspective in terms of the need for the team, the need for infrastructure, and the ease to make deals certain that we can get to closing. We know we've got our capital. We're not chasing capital for each deal, and phenomenal perspective. Now, you're 10 years in. You and your partner are relatively young guys, that at least the founding partners. I don't know if you've celebrated the 10th anniversary yet or just about to do so. When you're young private equity entrepreneurs, does that mean a trip to Hong Kong, to Las Vegas, something exciting to celebrate the 10th year, or just back pens to paper and getting back to work? What does that mean when you celebrate the 10th anniversary?
I think really the latter. There's a lot of milestones that you have as an investment manager, right? Closing your first deal, and then closing, your next biggest deal, and closing your first successful, leverage buyout, if that's the right you go, and then your first successful exit, and your first institutional investor. There's a lot of milestones, and I think short-term things that say, wow, this is a massive milestone for us. We've really gotten to the next level. But I don't necessarily think that in terms of years, that's a milestone. And so, it's great to be able to say, hey, we've been in business for a decade now, and have a decade worth of transactions that we've done, and a track record that we're proud of and can point to. But I don't necessarily think we'll have a big 10-year party or anything like that. We'll just be very much planning for the next year.
No, it's actually phenomenal. It's actually, and I wouldn't understate, though, very few funds. You see these mega funds, that have made it to 30 years, 50 years, 20 years, whatever it is, and there's them in every city. But at the end of the day, if you really did a count of all the funds out there and those that actually thrived and survived for 10 years plus, I know there's different evolutions of it. The first couple of years might have been as an independent sponsor, might have been more recently that you're truly a committed capital fund. But at some point, there is a great there is a great cause to celebrate what you and your colleagues have done through the period you've done it and gotten to the point where you are. So even if you won't celebrate it, we will celebrate it in the Becker Private Equity and Business Podcast. So congratulations. And Sean, thank you for joining us today. It's really amazing what you've accomplished. So thank you very much for joining us.
Thank you. And thanks for having me.